this is a foundational transformation we see happening in the economy.
DeFi and blockchain are redefining business, economy, and ultimately society.
All right. Hey, everybody. This is Megan Guy. I'm here with my fabulous co-host, Jeremy Almond, to bring you another episode of the Redefine podcast, where we talk about real-world applications for blockchain, crypto, and the transformation of our financial sector. Jeremy, tell me a little bit more about who we have with us for conversation today.
Awesome. What's up, Megan? What's up, everybody? Stoked to be with you. Today we have a killer guest, a good friend of mine, Salil Petroda, who's basically been in fintech for a very long time. Started his career off in investment banking, then was working at big tech at Facebook, started his own fintech cross-border company, which sold to MasterCard, and then has been working with all kinds of transformational financial service companies. He's on the board of blockchain.com. And so I'm really excited because we'll have a pretty wide-ranging conversation. Salil, what's up? Good to see you today, man.
Great to see you guys. Thank you for the kind introduction, Jeremy.
Awesome. Man, there's been so much going on in financial services today. So one of the things I thought we'd kick it off because both of you have been in your careers in investment banking is, a lot of changes going on in financial services. And, so Salil, you were actually in Wall Street during the great financial crisis. And so I'm curious, how you're thinking about financial services, post SVB, post Credit Suisse. How are you kind of looking at the world? Because all of us have been 2008. The world has now shifted with blockchain. And so just what do you think post great financial crisis and now today in a new potentially financial crisis?
Absolutely. It's great to be here, Jeremy. Thank you to you and Megan for having me. And congrats on, everything you guys are both building. So my perspective is, comes from a couple of different vantage points. I grew up in the growth equity investing business, and then I worked for a hedge fund that was bought by Citigroup in 2006, and my boss actually became the CEO of Citigroup. And so I was there during 2008 and 2009 during the financial crisis, and so learned a lot of lessons then. I guess a couple of points about then and then today. It's a complex, dynamic system. As you know, there's some really, really good people trying to do really good things to serve consumers and businesses, but there's a lot of moving parts and a lot of risks that need to be managed, right? And a lot of models that try to predict reality. So back then, I think, obviously there was a lot of systemic risk, and I think banks have been regulated to a different extent today. So as you know, there are, globally systemically important banks, which are fairly well protected. I think the SVB situation, unfortunately, was quite sad, and it's a function of the fact that the world has changed, right? We lived in an era of free money and very low interest rates, and interest rates have come up, as you guys all know, to combat inflation, as they should. And as a result of that, that's created what I would say is an asset liability mismatch in banks, right? Banks are borrowing short and lending long, and obviously when interest rates went up, the value of those assets declined on a mark-to-market basis, right? So I think it's something that was sort of hiding in plain sight, but obviously something that is going to continue for a while. I think the FDIC and the Fed did the right thing by protecting depositors. You and I certainly don't have the skill set to be able to read a bank balance sheet and understand all the risks. And so I think by protecting individuals and by protecting businesses, that Monday, which could have been very scary about a lot of startups we know making payroll, ended up not being that big of an issue. Having said that, as you know, there's going to be a bunch of different impacts, right? One, on the Silicon Valley ecosystem, SVB was so entrenched in terms of lending to individuals and businesses. And so I think you'll see a tightening of credit, a little bit more risk aversion. And then likewise, in the broader economy, I think banks are going to tighten credit a little bit, and that'll cause a little bit of a slowdown. So I would say, there's a number of complex factors being balanced right now. I think we will see more stresses in the system because of higher credit. But at the same time, people are doing the best they can. And we are so lucky because we have a bunch of different financial services and even parallel financial systems emerging, which I think were created for just this kind of a time.
Yeah, Salil, I totally agree with all of that. I think one of the really positive changes coming out of this that we're starting to see already with our portfolio companies is diversification, right, around banking services. And obviously the way that venture debt lending has been structured with some of the banks in the past, including with SVB, made it very difficult for people to experiment and think outside the box, or, put their money into a variety of different structures and instruments that weren't managed solely through that one provider. But I certainly think this is going to be an interesting moment, not only for DeFi, but all sorts of other opportunities as we rethink what kind of trust should look like in this system, what the role of the regulator is, right? I mean, yes, things were much more regulated today than they were in 2008, but we also saw a lot of those regulations rolled back as far as kind of some of the stress testing, right? You've probably read about that, everyone. And so, yeah, I think it's a new era of both thinking about regulation and also thinking about, optimization from sort of a company's perspective or an individual's perspective.
You're totally right. I think in this new era, like risk management and trust are going to be so important.
Yeah, and one of the things there is that implies this notion of counterparty risk that I think was less evident, where companies or fintech organizations in general might have been built on some of these systems, and all of a sudden something like cash being trapped all of a sudden became existential, right? Yeah. And it's not that anyone, I think we all know people at a number of these banks. It's not that there was any one person that you want to say is the issue. It's more around endemic counterparty and centralization risk that matters. When 5 of the largest banks basically is where most fintech companies sit, and we see what happens with counterparty risk. I can't tell you how many cases that I was aware of behind the scenes where there were fintech operations who actually might have gotten frozen, right? Or treasury that might have gotten frozen. And so the diversification matters just so companies actually can, do their operations in a way that, is in some ways mitigated against these kinds of challenges. And so, I think all of us, it's one of the reasons why we bet on blockchain. It's one of the reasons why decentralized finance matters. And so I think, if you kind of look at the other side of that, there's this other side of the world outside of traditional financial services that have been building new financial infrastructure, right? And this is what blockchain, this is what crypto is. So you've sat in one of the largest crypto exchanges since a very, very early days. And so I was kind of wondering if we could actually pivot over to that for a minute, because that's almost a totally different world, right? And so what's going on maybe in the crypto exchange world right now? How has it changed over the last, 7 years since you started working with that company? And where does, DeFi in general, and where does sort of these new digital assets maybe become solutions to the problem?
Absolutely, Jeremy. So listen, I think you've talked about a lot of important points. Let me say first, the traditional financial system serves people fairly well, and people are doing the best they can, and they're operating according to their incentives and according to the existing system architecture, right? I do think that, blockchain and DeFi are conceptually amazing, right? A decentralized, trustless system where you can have peer-to-peer exchanges of value in a totally transparent and open way. And I think both at the consumer application level, but also at the B2B infrastructure level, it's going to be very, very interesting. These are long duration phenomena, as you know, and there are peaks and valleys and hype cycles, but you can see a tangible value proposition and use case, right? So as you mentioned, I've been very fortunate to be a board advisor, an early investor and friend of blockchain.com, which is one of the original crypto wallets and exchanges. And the company started as an explorer that tracked activity on the Bitcoin blockchain and an API, but has evolved into a wallet, a very trusted wallet, both general custody as well as self-custody. We have about 86 million wallets right now, about 37 million verified users. I got involved when it was 1 or 2 million wallets. So I've really seen the exponential growth curve and the value it's adding. And so the first piece is the wallet. The second piece then is really institutional grade custody and the exchange, which allows trading and buying of different crypto assets. And now we have a DeFi wallet. And so I've really seen the ecosystem scale, from blockchain.com with a lot of security, a lot of integrity, and with good governance. And I think that's what we need. As you know, there are some use cases that are very relevant today. I think the ecosystem is going to have to continue to, both on the consumer and the business side, create use cases that are relevant. But at a conceptual level, it's less friction. It's a better tech stack. It's better, faster, cheaper. It's more transparent. It's global. And it's very, very decentralized without a single point of failure, right? And so I think it's a very, very elegant system for certain processes and use cases.
Salil, can you talk a little bit, though? I guess one of the things, it's both a, I don't know, it cuts both ways, right? Is this trustless notion. Because it's quite important, right, that we do have trust in a counterparty or in an exchange to make sure that the counterparty we're doing business with is who they say they are, isn't, a terrorist or using those proceeds to fund illegal activity, to say nothing of obviously some of the poor behavior we've seen from the leaders of the exchanges themselves in recent months. What's the right role, I guess, for trust in a decentralized, trustless system? Where do we find that? Whose responsibility should it be?
It's a really good question, Megan, and one I don't have all the answers to, but I think it's so important because trust is the foundation of commerce and the foundation of counterparty transactions, as you know. I would say that there's some responsibilities at the company level and some responsibilities at the ecosystem level. At the company level, there have clearly been some bad actors, right? And I think people who, do what they say they'll do and are adequately capitalized and know the role of leverage, right? I think those are really important things to build trust at the individual company level. And then this is kind of the wild, wild west. And, consumers do need to be protected. Businesses need to be protected. And so there is a place for regulation. And I think the best companies I see, including blockchain.com, are really working with the existing regulatory system to create safe, trusted companies that have best-in-class governance that can onboard people onto the crypto and DeFi ecosystem in a high-integrity, high-fidelity way.
Yeah. And certainly we need good actors in the system with good institutional grade infrastructure and generally lawful behavior, right? I think we'd all agree on that.
Yes.
That said, I'm interested in the counter side of this for a minute, because self-custody, I think we should talk about self-custody, because the question to me is, how much can we actually reduce risk by reducing the need for trust? I think there still always will be trust at some level, right? Commerce requires trust. But, the internet is a open system that's able to kind of move around where there's basically inefficiency in the system. And what I wonder is, how much are we trying to rebuild trust versus actually build infrastructure that doesn't need it? The example, right, is, again, the financial infrastructure. A lot of people don't realize that their bank deposits are not hard money, right? And that becomes really real, whether you're an individual or corporate treasury, when there's challenges with the bank. One of my favorite movies, It's a Wonderful Life, during Christmas time, I love, kind of described this, right? This weird phenomenon. I do wonder what the role of self-custody is, particularly for individuals, because a lot of the challenges you hear about both in the banking sector and in the crypto sector would have been mitigated if there was actually self-custody, not your keys, not your coin. And so, blockchain actually was one of the earliest self-custody wallets. And so it's I wonder if you could just talk about that, because I personally think that is a way to actually improve trust by reducing the need for centralization.
So Jeremy, I think you raise a really important point, because ideally in a perfect world, everyone is a good actor, but I think you have to build resilient systems with risk management where that's not always the case. And I think there are two pieces of it with blockchain type infrastructure that I think are worth discussing. The first is self-custody, which you talk about, which, in my simple understanding is really you have responsibility for your assets. There's not a third party bank that is holding them for you. They are your assets, right? And so blockchain.com was one of the original wallets where you had your own keys and you were the only one who could access your crypto assets with those keys. The positive is complete control. The negative is if you lose your keys, you're not in a great place. But I think taking a step back, in a world where there's a lot of counterparty risk, where there's a lot of volatility, where monetary policy is, has many competing objectives, one of which is to, stop inflation, but also encourage economic growth and employment. You're seeing what one could probably say is, different levels of debasement of different currencies, right? And so the idea of a store of value that you control, which is not within the sovereign system, I think is very appealing for people. And again, it's one use case right now, and it has to obviously interact with the financial system. But I think self-custody is really important in that sense. I think especially as you think about B2B applications and institutional applications, we have a world where a lot of things are built on the Ethereum blockchain, and you have smart contracts. You have complete visibility, auditability, and you can set rules about risk parameters, right, that automatically clear. And so it's not dependent on my mood on a given day or, the incentives that someone else is set up for. It really works in a much more, I think, rigorous fashion, right? And in that sense, I think, the appropriate type of new next generation infrastructures combined with human judgment can create a better system.
One of the things we're keying in on right now is just, the challenges in some of the U.S. banking system. But we know that those challenges are global too, because everything is interconnected. And that's actually the challenge is when everything is interconnected, single points of failure become either high risk or high cost, right? Because cost and risk go hand in hand. And so I want to talk about cost in general, because in the global sense, cost is very high in cross-border transactions. You started a cross-border company, a decade ago, pre-blockchain, pre-Bitcoin, pre-Lightning, kind of pre-smart contracts. But there's still massive amounts of cost and risk in the global transactions. And that's one of the most interesting B2B use cases, I personally think. So what's kind of the learning now, post your startup, post MasterCard? Now you spent a lot of time at blockchain.com and you spent a lot of time with these cross-border companies. How would we think about global commerce, in a blockchain and DeFi era?
Absolutely. Well, I was lucky, as you mentioned, to be one of many founders of a mobile payments company that was last generation. We did digital wallets for in-store, near-field communication, commerce and transactions, and mobile web and mobile app transactions. And we operated on a very global basis as different geographies had different levels of penetration of digital commerce and digital wallets. We were bought by MasterCard, and we're now MasterPass, their global payments backbone. And it's been very fulfilling to see that technology scale and serve a lot of people. I think the cross-border point is so important. The world is more interconnected. It's more global. Every place has their own KYC rules, their own standards, their own, customs. And I think as a result of that, there's a lot of friction in the system, right? Both process friction on consumer and business payments, as well as economic friction, right? You have some companies that have made a very nice living out of facilitating cross-border payments and the FX spreads that are in there, right? So I think one of the interesting applications I've seen tip from my blockchain.com vantage point is remittances, right? P2P remittances where, we don't have to work at this. We don't have to be at the same bank. We don't have to be in the same currency. We can, in a very trusted fashion, send peer-to-peer money across the globe. And I think that is a very tangible use case with much lower friction and much lower cost, right? And so it creates opportunity. And related to that is, I think, the second point, which is financial inclusion, right? We're very lucky here in the US, but there's a whole bunch of people who, are not part of the formal financial system, don't have credit, yet, are great stewards of commerce and, want to grow the pie for them. And I think this technology allows people, anyone with a smartphone can be their own bank and can be part of the financial system and payments and establish credit and transact. And I think that's very, very powerful because the barriers to entry are much lower because of this, really interesting new technology.
I spent some time in the last few months in El Salvador, and I'm just blown away at kind of the level of sort of growth that's happening in that space. There's now more wallets, and I think a year of deployment there. So digital wallets that are their own self-sovereign banks, than there are, actual bank accounts in, and I don't know, 50 years of banking history or whatever. But I think it was 15% of the economy there was remittance back to the U.S. And so one of the primary use cases was, could we actually lower the cost of remittance for those payments back to the U.S.? And then would we make it easier for people who didn't have access to banking to be able to receive those remittance and then put them back in the economy?
Those use cases, those two use cases are working, right? And they're very, very tangible. And they have a lot of utility for people.
I think it becomes a little bit of a question of friction, right? I think part of the reason why we've seen such huge uptake in places where you have had a lot of people that haven't had access to financial services, right, is there's no point of comparison. There's no transition. There's no, if you haven't had a bank providing custody services for you in the past, self-custody is a lot less scary than it is, right, if you are in the U.S. and coming from a more traditional financial institution. How do we sort of get past that friction point to see this sort of broader adoption, across developed markets as well as emerging economies? I think one of the things we've seen in the U.S. certainly is, in the absence of really clear regulation and strong consumer protections, huge fear that all the people that are coming online and creating wallets, are ultimately not going to have the level of information needed to manage those safely, right? We're going to be taken advantage of by bad actors on the system. We see rug pulls all the time. And so how do we I'm curious if either of you have seen things that have worked really well. I mean, Jeremy, your business has done a really nice job, I think, removing that friction layer for companies to pay one another. But how does that translate to more of a consumer space?
You do need good actors. So my view is you want infrastructure that requires less trust and more decentralization. That creates less single points of failure. But you still need good actors in the system at institutional grades, whether that's a Paystand or it's a Coinbase or it's a blockchain.com. These are folks that are creating institutional level services that create large value. I'll give you an example of a Paystand use case that came out of the kind of most recent banking stuff. We had most of our customers don't actually work in tech. Most of our customers are not kind of based in the Bay Area. They're what I call the real economy. They're manufacturing companies, supply chain companies, logistics, very unsexy businesses that are actually building real goods and services, which is the foundation of our economy. And one of the things we wanted to do was make sure that it was easy for them to be able to move their cash in a better and faster and cheaper and more efficient way. And where that cash sits matters. So in this case, we made it easier for them to do smart routing for their bank deposits. So with a smart contract, make it super easy. So you could actually route against multiple banks as opposed to having it in one single place. Okay, that's a smart contract that decentralizes your depository risk. We make it easy on our DeFi card for you to be able to receive money and then spend that money all kind of within the DeFi network and not have to go out to bank deposits. Again, our customers still have normal treasury and normal banks and a normal sort of, where you'd expect deposits to be. But these are ways to be able to make it work easier. Same thing on the consumer level, I think. I think people are on the consumer level looking for infrastructure and services that they actually can have other assets, other access to financial instruments today. It's happening faster in the emerging markets because the pain is even more acute. If you have 100% inflation, if you have 15 or 20% cross-border fees, the pain's super, super acute. But we're seeing today that the pain is actually important as well in the mature markets, and so those two things are going together.
Absolutely. No, I think you said it very well, Jeremy. I think in emerging markets, the pain is so acute from a friction and an inflation perspective that the use cases are very clear and people get it. We're lucky here in the U.S. to have a much more robust financial system. Having said that, I think the store of value use case is definitely starting to tip here because of network effects. And I also think, on the consumer side and then on the business side, I think the Ethereum blockchain really has scale of developers. And I think what people like you at Paystand are doing is fantastic, because I think what it really does is it starts this process of creating the next generation of financial rails on a decentralized, trustless, better, faster, cheaper, more transparent infrastructure, right? And so you're taking friction out of payments. You're also adding a lot of transparency. And ultimately, you're allowing people to get quicker cycle on payments, which is the lifeblood of commerce. But the existing financial system, while it works well, is built on some fairly antiquated technology. And I don't think it's a revolution. I think it's an evolution about processes being built on new DeFi rails and then also plugging into the traditional financial system. But I think you'll see a much more fine segmentation about where this new technology can really add tangible ROI and value and work and interoperate with the rest of the world.
I love that evolution, not revolution. I'm going to steal that because I think so often this conversation just gets reduced to burn down the banks versus, crypto is evil. Like, it's so binary. And the fact is there's a transition taking place, right? And same, I think, as we started with at the beginning of this conversation around SVB and people starting to diversify the places that they keep their money. I think that's actually the right way for this to evolve and for people to gain trust and confidence. Debate the pace, of course, but yeah.
You're totally right, Megan. And what Paystand's doing just in terms of embedding the smart contracts and embedding intelligence into the Internet of Value, there's so many profound implications of that we still have to figure out in terms of use cases.
Yeah, we have to build bridges, right? Like if you're building tomorrow, you still have to build bridges to them. And so, I think that's one layer that we're seeing is the infrastructure to build bridges, which a lot of that's happening behind the scenes because it's sort of value driven forward. There is something implied in what, Salil, you were saying, though, I think in terms of network effect. And Megan, you know this from, a lot of the investment work you do in general, which is we may not actually feel in the US the critical mass yet because the density of the people using it day to day might not feel close enough. So you were at Facebook, there was a moment, right, where, it was just at Harvard, it was just at Stanford before it'd been everywhere. On the digital asset side, we have, I think, 100 million wallets now that are in use or more. But it might not feel like that to everybody because we don't know everyone. And so I think that's almost easier to see in the emerging markets. El Salvador is a small country, so it's kind of almost easier to see everybody using it. I'm curious how you think about the network effect growth in digital assets and Bitcoin and Ethereum and other places, because there's this question of, is it going to be 1,000 tokens? Is it going to be 5 tokens? As someone who saw network effect at the granddaddy of network effect businesses.
I was lucky to learn a lot about network effects at Facebook, and I didn't really understand them. And when you dig into the math, it's so interesting. And just, thinking in exponents is a very different exercise from thinking in a linear fashion. As you know, network effects are such a powerful force in business these days, where, as you add nodes or users to a network, the utility increases for everybody, right? And I think you've seen that in the crypto space, certainly with Bitcoin, right? If someone has Bitcoin and Bitcoin One, they're going to send me a remittance. I will pull down a Bitcoin wallet to be able to accept that remittance, right? So I think it has those viral network effects. And you've seen this is one of the, I don't know the exact numbers, but this technology in 10 years has gotten to a much higher user base and a much greater level of penetration than most others, including the internet, right? So I think you do see network effects, certainly in Bitcoin as a store of value. As you know, Megan and Jeremy, there's also network effects in terms of developers and people writing to certain standards and certain protocols. And I think you have that on the Ethereum blockchain for DeFi and for smart contracts, right, in certain processes. So I feel like those two are really the blue chip assets. I think there are a variety of other digital assets with really interesting use cases. I think those are all trying to scale. But from my perspective, given, the prevalence in emerging markets and even here of Bitcoin as a store of value, and then with Lightning to potentially, enter payments, and then Ethereum as the, next gen financial backbone for, a supercomputer of value. I think those things are have tipped and are super exciting.
Yeah. There's a density in these places, and they're not seen well. But if you take the Ethereum development, for example, or Bitcoin Lightning, those are the two areas where there's enormous amount of engineering infrastructure, and they often say, right, the where the smartest engineers are working on their nights and weekends and hacker time is actually where tomorrow's going.
Total.
And so I think that's what's easy to miss in the space right now is all of the energy that's going on, because those infrastructure are being built. the nodes are getting denser. Lightning is actually growing faster than Bitcoin. Bitcoin grew faster than the internet. And it's just a matter of time between when you have it and I have it, and we start transacting quicker, which is really interesting.
The point you made about, we read about volatility in crypto assets, and that's one part of it, but there's some very significant scale building going on right now that's part of a longer term secular trend, even in a crypto winter.
Yeah, Megan, you see probably a lot of those companies right now that are still under the radar, right? So like in a crypto winter, what is the building infrastructure vibe that you're getting just in general? A lot of times the best companies are actually built in the down markets, right? So
yeah, well, that's certainly I think what we're hoping as investors in the space. Yeah, look, I think when you're in a down market, a founder said to me the other day, like, the people that are here today really want to be founders, right? This isn't just, I just finished business school and I don't really ever want a boss again, so I think I'll start my own company. Like, what should I do, right? This is an era where being a founder is really hard and money is much more expensive, and only the best of the best are getting funded. And so, not only I think is there a deeper level of commitment in some respects from the people that are out in the ecosystem, but I also think they're building businesses with a little bit of a different lens, where the focus is not on just top line growth or these crazy beliefs you have to have. Crazy is maybe the wrong word, but pretty significant beliefs that these network effects are going to follow, and there may not be no dollars transacting today, but if you get enough users, that will come, right? We've seen a lot of businesses in the last couple decades that have been built around that mode, some successfully, most not. The businesses that people are creating today just have a deeper understanding, I think, of costs, of the challenges of actually getting to network effects, right? We talk about it like it's something that every tech business has. It's actually very rare to see the sort of two-sided network effect that you've seen with, Facebook, now Meta. And I think people often underestimate just how difficult it is to actually get a marketplace like that working at the scale that you need to deliver those sorts of returns. So that's kind of general. I'd say on the crypto side in particular, what I've observed is the folks who are in it to win, And if anything, it's like the crypto winter has been taken as deeper motivation, and people digging, that much harder, digging in their heels, that like, this is the future, and I'll be damned if anyone's going to tell me differently, regardless of where Bitcoin is priced today, or, FTX being on the front page of the paper every day. Like, this is happening. It's the future. The true believers are true believers. And I think that's what we need in a lot of respects. I haven't seen huge, we've obviously seen valuations change and things like that. But I think some of the weaker companies that people were pitching and maybe getting funded in the last couple of years because crypto was just so hot, those don't exist anymore. Those are folding by the dozen. But the really robust infrastructure and, the pieces where I think we're seeing a real use case, and, as you put it, the real world is using this stuff and benefiting from it, those continue to grow. And that's what I'm most excited about in the next, we'll see green shoots, right? And crypto spring.
Totally. And people still have a lot of conviction, which is really nice to see.
Yeah. Well, look, maybe to the counterpoint of the earlier discussion, those who have dug in and are in it for the long haul might actually believe in revolution, not evolution. What's the saying in a smart contract or in a Bitcoin? Like, we replace the whole industry in 10 lines of code. So that's the tech opportunity. On the other hand, you guys know this well. Getting companies to scale, even if the technology is, sort of transformative, is actually quite hard. Building these moats at the business level is actually quite hard. And you can't discount the level of scale that incumbents have that can bring to bear. So as much as, I think there's a lot of opportunity at the early stage for, these companies to kind of reimagine industries, there's also a place to play for the incumbents. And so I am curious, you worked at Facebook, you worked at MasterCard, and you've been involved with a number of the large institutions. what's the role the incumbents play in the blockchain ecosystem? Some of them had projects. Some of those projects have now, were kind of more vanity projects or PR. How do the incumbents evolve, into the new technology as well?
Incumbents have existing customer bases. They have longstanding business processes. They have trust, and they have distribution, right? And so you see, whether it's the financial institutions or the credit card networks or other financial intermediaries, I think they are a bulk of the economic value in the industry, and I think they're going to be critical players, right? I see a couple of things happening. One, I do see players doing some experiments, given still an uncertain regulatory environment and an uncertain use case environment. But I do see with big companies doing very thoughtful, measured experiments about ways they can offer digital assets to their customers on the consumer side, and also underwrite and re-architect some of their processes with DeFi infrastructure on the business side. So I think that will happen. Again, those companies will take their time, but they'll do it in a high quality way. At the same time, I think for startups with new technology and new ideas, there's an interesting partnering opportunity, right? As I've worked with bigger companies recently, I've found a remarkable cultural affinity for trying to work with startups and learning new ideas and partnering. And so I think a best-in-class technology combined with best-in-class distribution could really accelerate time to market, right? So I think those are the two things I would see there from the technology in particular. And then the other angle, which Megan was alluding to, is just good old-fashioned business building, right? And doing it the right way. And, we've been in a somewhat artificial environment, as you guys know, the last couple of years due to easy money. But at the end of the day, the ability to build a business, both from a technology and a business perspective that can scale well, that serves customers with high fidelity, that takes care of employees, that, is a good steward for all of its constituents, and does it with, good unit economics and a good business and financial model that's sustainable across economic cycles. Like, that stuff ultimately never goes out of style. And I think that's a very, very key capability that incumbents have. And, some of us who've been around the block have, and I think I'm seeing certainly in my networks in Silicon Valley and crypto, really a maturing of people's mental models around saying, I'm doing very cool, revolutionary stuff, but I need to do it in a sustainable way, in a sustainable business, right? And I think that's a positive. In spite of the short-term pain, I think that's a long-term positive for the ecosystem.
Totally agree.
Yeah. Well, look, I think we all want to see these category-building companies actually, sort of get out and become, sort of the next winners, right? The next incumbents. And so, whether it's the next Facebook that created social networks, the next Salesforce that created cloud, Google, which created kind of the internet. These tentpole companies are required to kind of actually create credibility in the industry. Both of you are working with companies that are in that part of the journey, right? Going from early stage idea, trying to be revolutionary, to the ones that are actually holding the industry up. What do we think is needed? What's next or needed for the next Salesforce or Facebook or Google in the blockchain space to actually kind of make it real? What are we missing? What's next? How do we get there?
I think it's kind of steady progress, as we've been seeing, as we talked about, reducing friction and really delivering ROI to the people that are using that technology, right? I love kind of the Paystand story where your customers are not buying because they want to be involved with the next big thing, or they're eager to get into crypto and they don't want to miss out on the next internet. They're doing it because it makes sense economically, right? They earn a much better return on their cash. It makes them more efficient. And I think as that starts to scale, we'll hit some tipping point, I hope. Certainly for Paystand as an investor, I hope that, where, this becomes just a really positive feedback loop that perpetuates itself, and, more and more and more people come onto the network and realize those benefits. I don't think there's any one, unique piece of technology that's going to change things. We've seen plenty of brilliant technology built that, oftentimes the best tech isn't actually the tech that wins. But I think being able to remove friction and make it really easy for people to see the value in doing things a new way versus the old way is what ultimately is going to drive greater adoption and ultimately get us to kind of one of those big category defining winners.
I would totally agree with what you said. And I think it's tangible use cases with very hard ROIs that solve a problem in a more economic way with less friction. I think, the more and more of those we can get, like the Paystand use case is very, very clear, right? And the more of those we can get on the business side and the consumer side, where people don't necessarily care about all the underlying technical implementations, but it's just a better way to do things. I think that's going to be imperative for scaling some of these technologies and companies. The other thing, as you guys know, is I think we need some more regulatory clarity, especially domestically, so that innovation doesn't go offshore. I think we need to protect consumers. We need to have integrity in counterparties, but we also need to encourage innovation and experimentation, because these things, as you guys know, are never a straight line. But there is so much promise here that it would be great to have a lot of it onshore with the right regulatory framework.
The U.S. led the world in innovation in the computing platform, the internet platform, the mobile platform. It would be such a shame to see, the next platform of Web3 and blockchain not be led, in here at home. And so, I hope that the regulators and the politicians actually, we want smart, positive, protecting regulation with clarity. And if we do, I think the most innovative companies that are actually trying to move the ball forward will create an enormous amount of job creation, enormous amount of economic growth. And we can set ourselves up for, what the next decade looks like for growth in our country and around the world. But, it has to happen with good partnership. And so I'm hopeful. Let's see.
I agree with you. The economic impact of, the jobs that will be created on this new platform could be very, very beneficial.
Awesome. Well, with that, I think we covered so much, Salil. I am stoked that you got to spend time with us, man. This was super, super cool. Thanks for being here. Where else can folks, if they want to hear more about what you're up to and some of the companies you're involved with, where can they find you, man?
Totally. Listen, thanks so much for having me, Jeremy. It's awesome to riff on a lot of these topics. And Megan, likewise, really enjoyed the conversation. And thanks for what you're doing, Megan, with enabling companies. And thanks, Jeremy, for what you're doing at Paystand. I'm around. I'm on LinkedIn, Salil Petroda, and I always love meeting great entrepreneurs and great technologists and just try to do my part to help push things forward.